Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I welcome back Bob Elliott, co-founder, CEO, and CIO of Unlimited Funds, to discuss his personal portfolio and approach to investing. Bob's approach is centered around building a diversified strategy that goes beyond the 60-40 stock bond portfolio. As he explains, he believes in building strategies for many different market regimes and environments. This includes having positions in trend following strategies, what he calls diversified alpha, a big portion of risk parity, and a few other satellite positions to help with diversification. Bob takes a first principles approach to build an all-weather type of portfolio and derive returns from many different sources and assets. This is a good discussion with someone who has seen and developed top hedge fund strategies over time. As always, thank you for listening. Please enjoy this discussion with Bob Elliott of Unlimited Funds. Hi, Bob. Thanks again for joining us today.
Thanks so much for having me. Looking forward to it.
So we're going to do a show around focusing in on your personal portfolio, or I guess your investment game plan. And I think it's always good for us to sort of sit down with professionals like yourself, people that have experience in the markets, and for our audience and also us to sort of learn about how you view and manage your personal portfolio. And I think the conversation today, it's going to be closely aligned with what you guys do over there at Unlimited Funds in terms of running and building investment strategies. And so I think this is going to be a good discussion because it goes, far beyond the 60-40 stock bond portfolio that a lot of investors have, and kind of gets into some other, I think, more diversifying sort of aspects of how one can look at building a portfolio. But before we get into the specifics on that, we sort of like to start at sort of a high level, almost like a financial advisor would, and sort of ask you the question, like when you think about your portfolio and your investments and your goals, what would you say the long-term objectives are?
Yeah, it's a good question, and obviously, in some ways, the key place to start when I think about a savings portfolio, an investment portfolio for me and my family, I'm really focused on how do I create sort of durable long-term wealth creation. And at the same time, not worry too much about it. And those two things are important to connect to each other because in a lot of ways, being in the asset management business, both, originally being, at a hedge fund and now running my own business means that I have, significant, highly concentrated and somewhat volatile exposure to what happens in the financial markets and the success of the products and the investment management that I'm doing. The last thing you want to be doing in that context is worrying too much about your accumulated savings over time. Savings for a person who has a volatile income should be boring, right? Which is different if you have a low volatility income. Then it makes sense maybe to spend more time and have more volatility on your savings. But for me, really focused on sort of that long-term wealth creation, low volatility, moderately good returns, and something I don't really need to worry about too much in the day-to-day.
That worrying point is such a good example and an important one because, a lot of times, particularly when there's stress in the markets and people are seeing the value of their portfolios go down, it adds stress to families. People make bad decisions. And sometimes, a lot of times, the worst decisions at the very worst time. So I love this idea of trying to construct a portfolio that can grow, but you don't have to be overly worried about, for sure.
Yeah, I mean, I think there's I don't know if you read that work by some academics who are suggesting that you should just be like long only stocks and that's it. And like forget, the 70% drawdowns be damned, just keep going. Just hold the stocks, hold it through. Yeah. And the reality is that that people don't, struggle to go through periods of extraordinary volatility like that, even if, the rational self would say, look, over a long period of time, probabilistically, I'll generate higher returns if I experience much higher volatility. The reality is not, the thing that matters is not what the prospective returns are of the strategy that you're pursuing. The question is, what are the returns of the strategy that you can stick with it over time? And so I think that's a really important component of it where, I think for most savers, it's trying to have a pretty good return with and then limiting or moderating downside risks. And particularly if you have a volatile income, you don't want to be taking a lot of chances on your savings. The one thing you want to know is that the savings will basically be there when you want it to be there, regardless of what exactly is going on in the financial markets.
And this also, I think, ties in to some extent to this next question, which is about retirement, because I would think that in retirement, this type of strategy that we're sort of talking about here at a high level could be very appealing too for people that, sort of are living off their investments. But specifically for you, and this is kind of sort of might seem like an off the wall outside question, but we like to get at, even for young people or professionals that still have a lot of time in their career, how do you think about retirement? Do you think about it, or is that so far out that you're just not, it's really not on something you think about, or do you maybe think about it? I don't know. Where do you fall?
Well, I have to admit, I think the idea that I'm going to retire anytime soon or really at all is a low probability outcome. But I think I think part of that, I think you find this with people who have been in the financial markets and really enjoy it, that the passion and the fun of the day-to-day in financial markets means you're always going to be part of it and engaged. But I think the idea in terms of the savings, in terms of building a savings portfolio for that retirement point, is more about, you don't know when retirement is going to happen. And the reality is you don't really know when any big life event's going to happen. I mean, you could guess that your kids are going to, become 18 and then go to college and you'll have to pay for it. But what you can't predict necessarily is the macroeconomic environment that'll exist at that point and where exactly your portfolio will be at that point. And so that's why the really key focus is trying to create the most consistent upward sloping return over time and limiting the drawdowns, because the worst thing that you can have, let's just say, is you're turning from, working to retirement, or you're turning from not having to pay to college to pay the college, is a circumstance where you just experience a large drawdown and then you have a large, capital allocation that you have to start giving, and that just sets you back at that point in time. And so I think that's kind of, again, sort of going back to that, like, why does volatility really matter? Why does intra-experience volatility matter? It's because you don't know when you need the money and when you're not going to need the money. And given that uncertainty, consistency matters a lot more than end return.
I love, by the way, the fact that you're using the word savings, because it just makes you, when you talk about a savings portfolio versus an investing portfolio, you think about it differently. You think about, like, I want to protect my savings. I don't want to lose the money. So I like that reframing in terms of how people think of their portfolios.
Yeah, if you're gonna, and I think all of us who are in the investment management business spend some time in our personal accounts trading markets. And if you're going to do that, that's fine. But just that sort of allocation and that trading, that is not savings. That is speculation. That is trading. That is not the core savings that you're going to put away, that you're, by and large not touching unless you have these sort of meaningful life events. And separating those two things is super valuable. I mean, literally at the level of separating the accounts and making it clear that, certain accounts are savings accounts and you're not, engaged with them in a certain way. And if you're, trading them for your own personal interest, then just have an account that's dedicated to that and sized in a way that, if you lost it all, not that you should try to lose it all, but if you lost it all, it wouldn't be a big problem for your long-term savings position.
Yeah, it's interesting. Like, a lot of financial advisors will even advocate that. Like, take 2% or 5% of your money or something, put it off to the side and do whatever you want with it. Have fun, have a great time, but like, don't come asking for more money if you blow it. Like, put your core stuff, in something that you can stick with over the long term that has the potential to produce a good return for you.
Yeah, and it's almost better to have the two sets of accounts in totally different platforms. For instance, maybe you have a financial advisor that you're working with for your long-term savings portfolio, and then if you're going to have a speculative portfolio, you could have it on Interactive Brokers or in a E-Trade account, or et cetera, et cetera. So something that is just totally separate, where part of the idea of working with a financial advisor is not just to help you, help guide you through all of the various things that you have to do in order to, manage your money smartly and be tax efficient and all those things. There's also like a benefit of the friction. By creating friction, it means that you're not actually actively trading the account, right? You're saving in the account. And so I actually find that check to be a useful accountability mechanism to say, no, you can't just go do whatever you want to do with your long-term savings account. You have to sit there and have a check on your behavior, frankly, to limit or slow the amount of times that you're engaging with that. Because the best managed portfolios on the savings side are ones where you have a clear game plan that you can stick to, and one in which you actually stick to that game plan and don't divert from it meaningfully, given the flavor of the day or the macroeconomic environment.
It's funny that the type of strategy we're going to talk about today is something that for 40 years, basically nobody was talking about, because we got very lucky and we had a period where stocks and bonds were just working. And when stocks and bonds are working and people are invested in stocks and bonds, they don't really want to talk about this stuff. But before we get into actually what you do, I'm wondering if you just talk about the 60/40 in general and maybe some of the flaws you see in that type of approach.
Well, I mean, the 60/40 in a lot of ways is just a lesson in behavioral response to experienced conditions. We've experienced 40 years of disinflationary growth in the U.S. economy and really across the developed world, and an environment of global peace and integration. And the outcome of that has been that the two assets that do the best in good growth and low and falling inflation, which are stocks and bonds, have done the best and make up the core portfolio that most investors are holding at any point in time. And so, the 60/40 portfolio there's nothing magic about the 60/40 portfolio. It's in a lot of ways just the optimized portfolio for the recent experience. And when I say recent, I mean like the last 40 years kind of experience. And one that, everyone feels comfortable with given their experience. But just because we went through a period of 40 years of, falling inflation, low and stable inflation, and pretty good growth, combined, extended by a period of extraordinary monetary stimulation, doesn't necessarily mean that the next 40 years are going to look anything like that. And so I think that's part of the challenge is, how do you create a game plan that can prepare yourself for any macroeconomic environment, not just a macroeconomic environment where, growth is good and inflation is falling.
I'm just curious, if we look at that idea of low inflation and growth, and we went back a lot further than the last 40 years, like what percentage of the time does that exist in history if we look at a much larger period?
Yeah, it's a good question. I mean, a simple example is, you get significant inflation and deflation volatility, something like 25 or 30% of the time. When I say significant, I mean like above 10% and below 0% across the developed world. If you look across the developed world, across the last 100 years, for all the major developed world economies, it happens about 35% of the time, right? That you have either extreme inflation or extreme deflation. I think most people would be surprised that was the case, right? And those are pretty extreme scenarios. Above 10 and below 0 are pretty extreme scenarios, and ones in which the 60/40 portfolio in particular performs terribly in those sorts of environments. And so people have gone all in on one set of conditions that exists, with reasonable frequency, something like, I don't know, maybe half the time. That's a pretty good portfolio given the macroeconomic conditions, and have totally forgotten about the fact that, inflation can be way too high or way too low. Growth can be in a terrible state for an extended period of time. And that's when 60/40 doesn't work. So part of the idea here is to say we've gotten lucky, and recognize that we've gotten lucky, and start to think about a wider range of different outcomes than just the ones in the last couple of decades.
Before we talk about the details of the portfolio, I wanted to ask you about Bridgewater, because You had the opportunity to work there, and they're very well known for a very thoughtful process in terms of how they construct portfolios. And I was wondering, what are the biggest takeaways you took from that in terms of how you think about building your personal portfolio?
Well, I think probably the biggest takeaway from that is have the humility to have diversification, and that's a story that exists whether you're building a savings portfolio, whether you're building an alpha portfolio, whatever portfolio you're making. If you've been in this business long enough, you will be painfully wrong with some reasonable frequency, and the ability to succeed rather than fail, both in terms of building your savings and wealth, but also in terms of being a great investor over time, is continuing to play the game. And so a lot of times it can feel like you're paying a price. Diversification feels like you're paying a price because there's always a thing that's going up a lot. I mean, how many people like literally today are like looking at that Bitcoin, parabolic move and are like, God, I wish I put 100% of my portfolio into Bitcoin. But maybe Bitcoin succeeds and maybe Bitcoin fails. Maybe goes up, maybe goes down. The point is that you want to be in a position where whether you're right or you're wrong, you're still here to play the game and you're still here to build your savings. And so that's really what I think is at the core. I mean, a lot of the stuff that we did at Bridgewater, particularly in the alpha portfolio, was recognizing, having that humility about the accuracy of any alpha strategy and building portfolios effectively, relying on diversification in order to build more consistent returns. And the same thing is true with anyone's savings portfolio.
We've looked at a lot of portfolios in the podcast that go beyond the 60-40, but yours is very unique in terms of the four different buckets and the way you look at those four different buckets. We'll put the pie chart in the video so everybody can see it, but can you just talk about what those four buckets are and why they're important?
Yeah, I mean, I think if you think about a portfolio, when you think about a savings portfolio, the goal of a savings portfolio, as I said, is to build long-term wealth. And one of the key things to think about when you're building long-term wealth is you care much more about real wealth than you do about nominal wealth, right? So inflation, the biggest risk to any investor is an inflationary environment. And the reason why that is, particularly any 60-40 investor, and the reason why that is it's a period of time where your long-term costs are going up and where those assets that perform poorly in a higher inflationary environment are typically the assets that you're overweight to. And so that's really the idea here, is to say, how do we create a long-term strategic portfolio that in particular has the humility to recognize there might be a wide range of different macroeconomic environments. And then on top of it is recognizing that inflation is the biggest risk to any long-term saver. And so the portfolio that we've built, which I call the simple game plan portfolio, basically has four core assets. You could actually run this portfolio with 5 ETFs. It's the basic idea over time, which is you put about half of your capital into a risk parity portfolio, which is a balanced beta portfolio, which basically is a portfolio that is balanced, invests strategically or passively in a diverse set of assets like stocks and bonds and commodities and gold, and balances that allocation based upon whether or not based upon the macroeconomic environment. So you're not particularly exposed to one macroeconomic environment versus another. So if inflation is high or low, or growth is strong or weak, you're balanced to all those different outcomes. And then on top of it, take that portfolio. The trouble with that portfolio is it's a nominal portfolio. The balance is nominal. And so what you want to do to protect that portfolio is you want to add in, you want to be overweight assets that do well in higher inflationary environments. And so that means overweight gold and overweight diversified commodities in order to protect yourself in a higher inflation environment. The other two pieces are intended to, which are diversified alpha and trend following, are intended to add agility to the portfolio to navigate through different transition environments. And both of those strategies, trend following has a long history of providing a diversifying a diversifying return stream relative to strategic investing. And what I call diversified alpha, which is to find high quality managers at reasonable costs who have a consistent track record of adding additional return that is diversifying to your overall portfolio. So you take those four building blocks: risk parity, inflation tilt, trend following, and diversified alpha, and you put that together. And the basic idea is returns that are similar to what you'd get in a 60-40, which is your baseline, but ones that have about half the monthly volatility and meaningfully lower drawdowns.
How do you think about risk parity? I just know when you look at the risk parity strategies out there, there's a lot of them. There's people who say, you just need these core assets and that's more than enough to capture, the returns of risk parity. And there's people who hold all kinds of crazy things. Like, how do you think about that? I mean, as an investor's evaluating like different risk parity strategies, what are the principles you would use?
Well, I think at one level, it doesn't matter that much. And the thing that matters the most is that you just have a diverse, exposure to a diverse set of assets. And when I say that, I emphasize, and in particular, looking at that portfolio allocation on a risk basis rather than on a capital basis. So if you take the typical 60-40 investor, they hold, the S&P 500 and let's say the global ag or US ag bond index. Well, stocks have a lot more volatility than the bond ag. And as a result, essentially, that the portfolio, the typical 60-40 portfolio is like 98% correlated to the stock market. So like, who cares? You're not getting anything out of your bonds, right? That's the problem with capital allocating, is because the bonds just don't matter in the context of the overall portfolio. So really at the core of a risk parity portfolio is to say, instead of allocating based upon capital, allocate based upon risk. And you could do that in a bunch of different ways. Frankly, you could just take, the four main asset classes, which is, stocks, bonds, commodities, and gold, and just allocate them equally on a risk basis, and you basically have what you're looking for, right? I mean, so you could balance your economic exposures, you could not balance your economic exposures, you could just balance your asset exposures, and it's mostly fine. The key thing is to just get away from the all stock portfolio or the all stock and bond portfolio and build that diverse asset.
Just in terms of implementation here, I'm going to kind of step out of the holdings for a minute. And just in terms of rebalancing, the commodity sleeve is interesting. Obviously, that's going to be very helpful during times of inflation. But, commodities can go through long periods of either really good performance or really bad performance. And just how do you think about rebalancing and getting back to those target weights in the context of, having these types of assets in a portfolio?
Yeah, I think the best thing you want to do to build a long-term savings portfolio is to build a portfolio that you trade once a year. You just rebalance once a year, and you don't have to worry about it other than that. And I think you get cued on, do you rebalance monthly or weekly or daily and all those things. And the frank reality is, first of all, there's operational issues related to that in terms of taking on, costs associated, tax consequences and things like that with more frequent rebalancing. But there's also just the hassle factor. And what we talked about is building a long-term savings portfolio that you do not think about in your day-to-day. So what that means is building something that, basically is a once-a-year rebalancing portfolio. And the frank reality is, if you rebalance once a year, it's close enough, right? It really does not matter that much over a 30 or 40-year time frame. It doesn't make any difference.
So in terms of what's underneath the hood of the different asset classes, how do you think about that in terms of, you're talking about not wanting to pay attention to it that much. So do you just buy index mostly stuff on the equity side, or how do you think about that idea? Are you factors or what's underneath on the equity side?
Well, on the equity side, just index futures is fine.
Okay.
And that's, the reality is, for risk parity, my recommendation, which I get no commission for, would be to just buy our part of the ETF. It's fine. It's close enough. It's basically, the treasury bond futures and stock futures and, cash tips and other gold futures. It's just a simple construction of the traditional risk parity portfolio, just done in an ETF wrapper, which is, a lot more efficient for taxable investors to hold and execute on. So that's what I would do. Like, you could spend a lot of time trying to pick out stock factors and, slices and big versus small, international versus domestic, and all sorts of different things. And over a 40-year time frame, doesn't matter. Like, matters a lot more that you're balanced and that you behave consistently with it than it does whether you're getting into the details of, these factors or those factors.
Can you also dig a little bit more into the diversified alpha thing? One of the things people always say about alpha is it's very hard to find, and people who have it, lose it over time. So how do you think about like finding consistent sources of alpha that'll persist?
Well, I think probably in this portfolio, that's probably the most challenging piece of things is how do you find consistent alpha, and to be clear, at a reasonable cost, right? A consistent net of fees alpha, because there's a lot of good managers out there that generate very good alpha, and then basically just take all the alpha away for themselves in fees and leave investors not that much better off than they would be on their own. And so identifying good alphas means going through and looking for managers that offer a good, consistent alpha at a low cost. So, you should be looking for managers that have a fee structure where maybe they're taking 20% of the alpha that they're generating, and where the alpha that they're generating is meaningful relative to, just a plain index fund. So you're not going to spend much time, looking for little pieces of alpha or basis points of alpha. You want something that's meaningful. And so, the good thing is there's been a real proliferation of ETF structures and better and better alphas in the ETF context that you can go out and you can invest in. Part of why I started Unlimited was seeing that there was a real gap in the quality of the alphas that were available for the everyday investor to access them at a low cost. But leaving anything that I'm doing in my day job aside, there's lots of great managers that now are operating in that ETF wrapper that you can go out and find and include in your portfolio. The key thing is just not get overweight on one particular manager, one particular style, one particular strategy. Again, it's all about the diversification. Just in the same way you want to diversify your passive portfolio, your betas, you also want to diversify your alphas, because some alphas do well in certain environments and other alphas do well in other environments. And so creating that balance is really the key, not getting overweight on any particular strategy or manager.
Yeah, and to your point, like if you were trying to build this portfolio 10 years ago, it would have been much harder. There's so many great things that have been done, like what you're doing, what other people are doing in the ETF space to allow these types of things to be available to your average investor.
Yeah, and I think there's, you can go out and you can, again, leaving aside what we're doing, like there's, probably 24 ETF-based alpha strategies that have existed for more than 5 years that you can go out and, find and invest in today if you want to understand the return properties and engage with people that have nothing to do with me, that if you look at, how much alpha they're generating relative to their fees, it's a good deal. If you look at their absolute alpha creation, it's a good deal for you to include in your portfolio, presuming that they are able to continue to have that alpha persist over time, which, the last 5 years is a good test case because we've been through pretty much anything you could imagine in the last 5 years. So if you're going to do a stress test on a manager, this is the time. This has been the time the last 5 years.
I wanted to ask you about behavior, because this is probably not an issue for you because you're not sitting here judging yourself against the 60-40 portfolio. You're not looking at your returns and graphing them. You know the reason you're doing what you're doing, and you understand that some of the assets will be a drag during a period where the 60-40 is doing really well. But how do you think about that from the perspective of the average investor? Because that's something, we talked earlier about how they panic when their portfolio goes down. The other time they panic is when they're at the cocktail party, and their friends are all running with their stocks and bonds, and they're not. So I'm just wondering if you have any tips or any ideas around that, about how to stick with this type of portfolio and how to think about it like properly benchmarked.
Yeah, it's a good point. I can confidently state, and wrote something about this at the end of last year, that this simple game plan portfolio has underperformed stocks over the last 18 months. And that's okay. That's okay. Stocks got lucky. And you're building a portfolio that's not based upon getting lucky in terms of your picks. You're building a portfolio that you don't have to worry about, right? That's what you're trying to do. You don't have to worry about it. And so, those people who were cheering how well stocks have done in the last 18 months were also very concerned, just 18 months ago when stocks were at a 25% drawdown. When you think about this portfolio, and particularly benchmarking, I think particularly for advisors, peer risk is a real thing. And I think we'd be silly as issuers to fail to recognize that. If you're sitting in an advisor seat and concerned about how much you're tracking relative to the 60/40, one of the things you can do is start to think about how can you tilt your portfolio to get in this direction, or clients' portfolios to get in this direction, but also keeping enough tracking close to 60/40 that you don't create that peer risk. So just a simple example, if you just took 60/40 and then you took 10% out of it and allocated to gold, and 10% out of it and allocated to diversified commodities, and 10% and allocated it to, let's say, diversified alpha, you get a portfolio outcome that's still like 90% correlated to 60/40, but has meaningfully improved, something like 50% improved return relative to risk over time. And so that could be a balance. That could be the right answer if you're benchmarking to 60/40, is benchmark there and don't go all the way to a risk parity portfolio and 20% managed futures and all this sort of radical portfolio, simple game plan portfolio that I'm proposing here. But move in that direction. Use the lessons that this type of allocation shows to incrementally improve your client's portfolio while not introducing too much business risk.
Can you talk a little bit more about how you think about the trend following bucket, like what goes on under the hood there?
Yeah, I mean, for this work that I did here, the trend following is a very slow moving, it's just a 12-month change trend following strategy. And you would be surprised at how good slow trend following is in terms of generating alpha over time. And in particular, generating a return stream that can often be complementary to your beta portfolio, particularly in times of challenging beta environments, when stocks are going down or when bonds are going down. And so I think it's a sort of approach which you can either do on your own, which is you could create your own 12-month change in prices and trend follow and adjust the portfolio yourself. But the frank reality is there's a bunch of good managers that are out there that are doing this in the ETF structure these days that you could just go buy one or a handful. There's lots of great, particularly in the managed futures world, lots of great replicators that are out there that can give you this exposure and which allows you to basically run a multiple asset strategy all within an ETF wrapper, so that you don't have to take the capital gains and losses that you would take if you were managing on yourself. And all you see is the ETF allocation. And under the hood, you're getting that trend following diversification. So lots of great stuff that's out there. I mean, there's been a proliferation of these products. There's probably a dozen or so that are out there that are all, pretty good in terms of giving you access to this exposure.
Yeah, a couple of things with that. One is that point is really, really important about trend following, because it is so much better done within an ETF. If you're sitting there holding individual positions and you're selling them and buying them and selling them, it's horrible from a tax perspective. And it's very hard to generate any kind of return, even if you have some complicated strategy that you think is going to do better, that would do better than just doing it in a simple way in an ETF because of the tax consequences.
Yeah, and particularly those replicators, it's pretty good. If you think about a replication that's maybe 80 or 90% as good as sort of the real thing, if you were to invest in, let's say, a portfolio of managed futures managers directly, 80 or 90% when you're paying much lower taxes and much lower fees, you take 80 or 90% good all day long. Because what you care about is not, the perfection of the gross of fees, gross of taxes return. What you care about as an individual is the net of fees, net of taxes outcome. That's what you care about. And not having to worry too much about it, right? Like leave the trend following management to the professionals who do this all day long and just hold, one or maybe you can hold a handful of these strategies that are out there to get that exposure and just stop thinking about it. Don't worry too much about it, right? It's low stress, highly diversified with low stress. That's the goal here.
Yeah, the other thing you said that definitely rang true with me is this idea of simplicity. Because I've been the guy in my career that's like, I'll build a 27-factor strategy here to accomplish this. And then when you're done, you realize, the 2-factor strategy probably basically got 99% of the same place without all the hassle of it. So I think that's a big lesson in general, whether it be trend following or factor investing or a lot of the places, is sometimes the simplest approach actually works just as well as the crazy complicated one you try to make.
Yeah, and often the simpler approach is not only sort of on a backward-looking basis as effective, and on a forward-looking basis easier to implement, but it's also often more robust because it's not reliant on one particular set of outcomes that creates, factors number 10 through 27 working well, right? So part of what you care about, you don't care so much about how good does it test in the back history. What you really care about is how robust it'll be in the future. And I think going back to that sort of humility point that we talked about at the outset, like having humility to say that complexity does not lead to, it's not necessarily related to how durable the strategy is an important lesson in humility. That comes from humility, which is to say, maybe my optimizations just aren't that valuable and aren't that true, even though when I look in the back history, they look, truer than they probably really are.
I want to ask you briefly about international exposure, because that's a big debate you see out there right now. Is we've had this period where the U.S. has just killed international markets for a really, really long period of time. And some people think it's similar to the 60-40, where it's happened for a long period of time, but it's going to reverse at some point. And I'm just wondering, how do you think at like a high level about international exposure, like in the importance of having it in a portfolio?
Yeah, well, I think it sort of goes back to do you have any edge in figuring this out? And I think the answer is, most people don't have any edge in terms of figuring it out. And so more diversification is better than less diversification. And just because the U.S. has outperformed over the course of the last 10 years or 15 years doesn't mean that it will outperform in the future. I've been in this business long enough to remember when people thought the U.S. Equity market was dead and we should just only invest in emerging markets because that's where all the alpha is. Or, you should only invest in small caps because that's where the incremental alpha is, and never invest in large caps. Like things that, sort of are taken for granted today as being sort of truth, that U.S. mega caps are are obviously the best companies in the world. It wasn't that long ago when that's the exact opposite of that was what everyone thought was obvious. And so if you're building a portfolio that is meant to be, simple, that you're building over a 40 or 50 year time frame, a savings portfolio, what you want to do is you just want to build a diverse set of exposures. And so that would mean, holding a basket of both U.S. securities as well as international stocks as part of that portfolio.
I'm just curious, as before I hand it back to Justin, outside of your public portfolio, is there anything else major you do, like, whether it be venture capital, private equity, real estate? Is there anything like that you do outside of your public portfolio?
Not really, and I'll tell you why that is because the vast majority of private market exposures are not worth the cost and the illiquidity. And the reason why that is that, most of those exposures can be accessed through, you can get the same type of exposure in a public market structure at much lower cost than you can, in those private market structures. Like, if you were to take over the last 20 years, the Russell 2K value and lever it 1.75 times, like you'd have one of the best private equity firms in the world, right? Assuming that you match in the accounting. The fees of that would be essentially zero rather than 600 or 800 basis points. Like when you start to go into things that are illiquid and charge, 5, 6, 7, 800 basis points of fees, like you have to believe that those managers have magic in order to believe that those investments are worth it. And here's the dark reality is those managers don't have magic, right? They're constrained by the same constraints that exist in the public markets. And so if you want to talk about something that's going to be easy to deal with and also help deal with that question of you don't know the day in which you need your savings, constraining yourself or keeping yourself in the public markets is really the way to go.
You had mentioned Bitcoin earlier, and I think it crossed 60,000 or something like that. It's on a pretty crazy run recently, but do you dabble at all in any crypto, or are you kind of shy away from that stuff?
Yeah, I don't hold any cryptocurrency in my portfolio. I think when you think about where it fits, I think there are reasonable arguments that could be made that it is a money alternative in the same way gold can be viewed as a money alternative. It's not convincing enough yet to me that it deserves a role in the portfolio like that. But, is it possible? It's certainly possible. And maybe it deserves a small slice given, the magnitude of the adoption that has existed. But it's certainly not something that would likely be a meaningful component of a portfolio anytime soon, in part because its volatility is so extreme. So on a cash basis, so as not to take on too much risk, you'd be talking about tenths of basis points of allocation to cryptocurrency or Bitcoin in order to keep the same sort of balance in the portfolio. So the question is basically, is it worth the hassle given the size that it's going to have in your portfolio? Now that there's Bitcoin ETFs, you could see that it might be just easier and more sensible to include it in that contra currency bucket, but it's pretty on the margin.
It's just interesting side note. We custody and trade our client assets at Goldman Sachs. It used to be fully OFM, but now it's Goldman Sachs Asset Custody Solutions. And for my personal accounts, I just was curious. I was kind of looking at some of these Bitcoin ETFs, and I went and tried to see if they were on the platform. And not all platforms, so none of those ETFs are yet on the Goldman platform. And I don't know if they're going to be. I emailed in the customer service and I was like, are these going to be? And they're like, I don't know what they said. There's no, there's no plans to add these. So it's like, just because they're out there doesn't mean that they're even really available on all platforms.
Yeah, that's true. And certain platform providers may be more or less antagonistic to Bitcoin in the specific. I know there's tales of Vanguard being very proactive in excluding the Bitcoin products, the Bitcoin ETF products into the market. Look, the main thing I would emphasize is the construction or the issuance of Bitcoin ETFs is great for the individual investor because it brings regulatory oversight and the protections that exist in the ETF space to the everyday investor, and it brings down the costs of accessing those exposures by, they're now like a tenth of what they were before or even cheaper. And that's great for the customer. Great for the customer. Doesn't necessarily mean it's the right asset to meaningfully include in your portfolio. But if we're thinking about, what are the sort of innovations, particularly the ETF innovations, I'm an ETF guy. This is a great example of how the ETF world can create something that is just strictly, meaningfully better for the everyday investor. So maybe they get widespread adoption, maybe they don't, but at least there's an option out there that's just so much better for the everyday investor than existed, just a few short months ago.
Not to bring us down this crypto rabbit hole, because this is not where but what you just said is very interesting because, Coinbase, while they're a beneficiary on the custodian side with all these ETFs, and I don't know the economics behind it, but to your point, it's very expensive to trade in and out of these cryptocurrencies at Coinbase. If within the ETFs, if you're paying I don't know what the fees are, but they're got to be pretty low.
Some are as low as 20 basis points.
Yeah, that's crazy.
There,
So
there
just
are some, early issuances that are essentially zero, right? But let's call it, the going rate. The market on this is going to be, I think, 20 or 25 basis points, which, puts it as more expensive than stock indices. Vanguard is at 3 basis points or 4 for stock and bond indices, and the products have more complexity in terms of the custodying of the coins. But 20 basis points, as a simple example, is a whole heck of a lot cheaper than 200 basis points, which is what people were paying Grayscale before these ETFs got issued. And so that's strictly good for the consumer. There's no question about it.
how do you view home ownership in the context of your overall net worth and personal portfolio?
Home ownership, I think you got to live in a place, and it's not a savings asset; it's a consumption asset. And so, you live in a home, and you should be prepared for it to go up or down. And since you have to continuously live in a home, if it goes up in value, then if the home you're in terms of what you own, goes up in value, then every other home goes up in value and housing costs go up. And if it goes down, then housing costs go down. And there's no grand arbitrage. You could say maybe you could flip between renting and buying based upon the relative costs of those. But functionally, that is, in the spirit of trying to not spend too much time thinking about hassling yourself with things you can't control, like trading houses is not, is a very high cost, high transaction cost strategy, and isn't going to do much for you. So, I think about it like live in a house, and that's where I live, and I don't think too much about it, much more about it.
The one point that that I've been thinking about in the last year or so is, when I bought and then refied, I don't know, I have a 3% mortgage or something like that. And, where rates are today, it's the idea of buying a home or, moving and having the mortgage basically double effectively from what I'm paying now. It's just, I think, to the point on rates and the 60-40, and we were in this declining interest rate environment. And obviously rates got super, historically low. And a lot of people took advantage of that. But I don't, I think that it's sort of a challenging time, I guess, to be thinking about moving or buying a new home or anything like that.
Well, I think part of that is if you, it's a question of whether you borrow or buy on leverage for a home. And I think, that's traditionally it has been a wealth creation device, a middle-class wealth creation device, by borrowing money and buying a house that is larger than you could otherwise, afford if you were paying cash. It's not clear that that adding that leverage is necessarily what you want to do in order to create long-term wealth, and more often than not leads to buying houses that are too big relative to what you can afford. And so I think, in a lot of ways, most savers would be better off buying a house that is considerably smaller than what they could quote unquote afford, and paying cash for it than dealing, and not having the hassle of having to worry about whether or not, what's your mortgage, and is it low, and is it not low, and do I want to move, do I not want to move as a result of that? Way better off just, frankly, living within your means rather than borrowing to be above it. But look, in the context of all of this, I'm operating a lot more conservatively than how many people operate.
How do you think about kids and money? I have 2 young girls. Jack has young children. You have, do you have multiple children or just one? Okay.
Yep.
So, and we ask this question, and a lot of times we get just very different answers. So when you think about your kids and your legacy and leaving them something or nothing, how do you kind of think about that?
Well, I think long term, what builds long-term life satisfaction is to ensure that people are have a profession or trade or something that they're working for over time, and so what that means is, and I should say that, and to ensure that the basics are met. And those two things often are in contrast to each other, which is that, pushing oneself often will not happen if it feels like the day-to-day needs are basically largely going to be met. And so I think it is it's a challenge to balance those things appropriately. But I think it's a challenge where too often parents are tilting towards giving too much rather than pushing for their children to drive their own success, and that structurally leads them to actually, over the long term, lead less fulfilling lives rather than more fulfilling lives, even though in the moment it might feel like it's better for them. And so in that context, I think operating in a way that says, it's up to you to create the life you want to create predominantly. And, obviously in a worst case situation or an emergency or in a crisis, that as a parent you would deal with that. But by and large, focusing on ensuring that they have the challenge and the fulfillment of building an independent life away from parents.
It's interesting. We've had some famous investors on the podcast who, had the kind of means to set up trusts for their kids. And, when we asked this question, their reaction was, if I had to do it again, I probably wouldn't. So it is interesting to think about. Like, it's such an interesting balance. Like, you want people to be able to pursue, you want your children to be able to pursue what they want to pursue in life, even if that might not be something that has, significant financial rewards associated with it. But by the same token, like you said, if you don't have to get up yourself and support yourself and build something yourself, the motivation may not be there. So it's an interesting balance, and there's no answer to this probably, no matter how you look at it. People just try to figure out where they are in the spectrum, but there's really no correct answer to this.
Yeah, I mean, I think the key thing is there's always that challenge of the immediate relative to the long term, because the thing that's going to matter, when your child is at 60 or 70 or 80 is going to be how the 50 years went, not how the 5 years went, the most recent 5 years went. And so the question is, how do you set them up most for success from that perspective? And that's where creating self-reliance is a much better long-term attribute than any short-term support.
Just a couple more as we wrap up here. I always like to ask a question at the end to get to this idea that your portfolio is not all about money. So I have a sailboat, a racing sailboat. I live in Lower Connecticut. And a racing sailboat is not a good investment from a financial perspective. Like, if you did the spreadsheet on it, it wouldn't be pretty. But by the same token, I get a lot of benefits from it. I can go out on Wednesday nights with my friends and have a beer, and I get a lot of joy from it. So it's something I've invested in that's not a great financial investment, but has been great in my life. And I'm just wondering if there's anything like that you have in your life that may not be the greatest financial investment, but that you get a lot of joy out of.
Yeah, for sure. A big hobby of mine is gardening, and I once read this book. It was called The $64 Tomato, which is a guy basically took all the all-in costs. This person who lived on a sort of hobby farm in Hudson Valley. He said he took the all-in cost of land and the financing and the his time and all that stuff, and he worked it out to figure out that a single tomato would cost $64, which is obviously a horrific economic investment. Why you would spend your time creating your $64 tomato? And so I feel like gardening is the same way for me. Like, if you just took the amount of time and money and effort that I spend in gardening every summer, it would certainly add up to a pretty bad return. But it's a great hobby, and I enjoy it a lot. And there's nothing like growing something and then enjoying it at the dinner table. So while it's a lot like your sailboat, a waste of money and time for sure, you get a lot of pleasure out of it.
What do you grow?
My key attribute for growing things is something that tastes totally different and much better grown out of the garden than out of the supermarket. And so it's an odd collection of things. Tomatoes are obvious, but also things like potatoes, which you wouldn't realize are radically different, homegrown rather than out of the grocery store. And then for a long time, even as a little kid, I've always enjoyed growing pumpkins. So that's
very cool.
That's another thing. I grow a lot of pumpkins, which are pumpkins they're a very fickle crop to grow. Where some years, like last year, just incredible abundance, more pumpkins than I've grown in a decade, and then other years where the pumpkins tell you that this is not the year. So, that's the beautiful thing. Talk about humility in markets and investing. There's nothing more reinforcing of humility than gardening, where Mother Nature teaches you humility over and over and over again.
I wonder what's the big differentiator between the stuff that's like has the biggest difference between the supermarket and growing it? Is it like the preservatives they use on it, or is there like a factor to that, or is it just kind of a random thing?
Well, when the time and distance between when it's picked and when it's on your table is a big part of it, particularly around how the composition of the composition of the fruit, so to speak, is very different. So you have starch decay and sugar decay in potatoes as they get stored, or tomatoes. Interestingly enough, if you look at like the composition of tomato in terms of like its scent and its taste and things like that, it comes from the fact that it's not like a riper tomato is just more flavor than a less ripe tomato. It's actually just a totally different fruit in terms of the composition, the taste, and the various sugars that are included in it. So it's the sort of thing, a tomato is the sort of thing you actually cannot go to a store and buy and get the same product as you can picking it and eating it right away. You guys probably don't know, but my academic training is actually in botany. So, I could nerd out on this stuff for a long time.
We'll have to have you back on to do the botany podcast.
Well, I got to imagine there's some great blog posts that can go on unlimited, like the $52 potato, but it can kind of get into the investment realm somehow.
That's right. It might have taken you a dozen hours for one potato. I dig up my potato crop at Thanksgiving, which is particularly good because you don't know exactly how productive it's been until you dig it up and pour it out. And the great thing about doing that at Thanksgiving is that the family's there to see whether or not it's succeeded or failed.
Nice.
Are they kind if it fails?
We got to run to the grocery store. It failed.
That's right. Buy some of those crappy potatoes for the.
I'm a big potato fan, so I'm interested. Like, if they're that much better, that's pretty cool.
It's a totally different food. You'd be shocked at how much better potatoes are fresh out of the garden than they are out of the supermarket. You can grow them in small pots. You can buy cloth pots for $10 and soil and get seedling potatoes. The seedling potatoes are $20 and the pot is $10 and the soil's $20. Yeah. And you might get 3 or 4 potatoes out of it.
Nice.
But don't forget you have to water and care for the thing for months on end.
Yeah, this does sound like the $52 potato. Well, this has been great, Bob. We like to ask all of our guests sort of a standard closing question, and for these Show Us Your Portfolio episodes, and I think you've probably hit this many times throughout the discussion. But if you could impart one lesson to your average investor around your personal approach to investing, your simple investment game plan, what would that be?
I think the main thing is just have the humility to recognize that you don't know what's going to happen in the future, whether it's what's going to happen to asset prices or whether it's going to be knowing when you need the money that you put away from savings. And so while it can feel conservative and that you're missing out by not, going extreme in one direction or another, if you're trying to ease the mind and build wealth, having humility to diversify is your ticket to long-term success.
That's great, Bob. Thank you very much. Really appreciate it.
Yeah, thanks for having me. It was great.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.